Welcome to Property Unpacked, the podcast that unpacks the hot topics of property and explores how they affect you. I'm your host, Stolz, and yes, I have a bit of a cold. I'm fine, but I do sound a bit croaky. In this episode, we ask the question, will Australia's property market stay hot? Is the hot property market here to stay, or are things starting to slow down? After rapid price growth across nearly every part of the country this year, we're starting to hear rustles in the wind that the property market may shift gears soon. The winter market is usually when property takes a break, but will it this year? To discuss the year that we've had thus far and what we're likely to see through the next 3 to 6 months, we're joined by the independent economist Saul Eslake. Saul, welcome back to Property Unpacked.
Thank you for having me, Alice. It's nice to be here.
Now, so we've seen extremely hot market conditions at the beginning of this year. Are there any signs of cooling in those conditions, or is price growth and demand still a runaway train, in your opinion?
Well, there certainly doesn't seem to have been any slowing in the demand for properties in recent weeks. Clearance rates have been pretty close to 80% in the major capital cities, and prices have continued to increase over May at much the same rate that they had done in March and April. Real estate agents appear to be suggesting that one of the factors keeping upward pressure on prices, in addition to high levels of demand, is a shortage of stock. That seems to be especially acute in regional areas rather than in capital cities, and that reflects what I suspect may be one of the lasting consequences of the COVID pandemic, that there seems now to be a heightened interest on the part of a broader range of Australians in living in regional centres. And of course, people who do live in those cities don't seem to be as anxious to move to the big smokers they have been for similar reasons. And that seems to be maintaining some significant upward pressure on prices in regional Australia that for most of the last 30 years haven't seen anything like the upward movements in prices over an extended period that have been so much of a feature of our big capital cities.
We are still seeing a lot of strength in those metro markets, as you touched on. And one curious thing I noticed, I saw a lot of properties sell prior to auction, and I wondered if that could be a very unofficial indication of a bit of a changing market, that we're starting to see people think, I won't wait till auction. I'm not going to be as greedy as what I may have been able to be a few months ago. Have you heard about this happening or seen any signs of it?
Well, yes, I've certainly heard anecdotal evidence of that. And it could be, as you say, that vendors are keen to get a sale because they think that there might be greater uncertainty down the track. It could also be, of course, that would-be buyers are making higher offers before an auction for fear of missing out. So it's a bit early to tell. I mean, just as an illustration of the same thing, it was reported here in the Tasmanian media over the past week that people who haven't been thinking about selling their properties at all have been getting unsolicited offers dropped into their mailboxes, which I know does happen from time to time in Sydney and Melbourne, but here in Tasmania, that's a highly unusual thing. And it illustrates just the extent to which there is demand for property, and particularly good property, from all sorts of buyers across the spectrum.
So I'm just going to change gears a little bit now, but what effect do you see the recent federal budget measures having on the property market in the sort of short to medium term?
Well, I think the effect of the measures in the budget will be to put further upward pressure on prices, but only at the margin, because the numbers involved are relatively small. There were 3 measures in the budget that I think are relevant here. The first was the decision to increase the amount that people can withdraw from their superannuation funds, or more specifically from their voluntary concessional or non-concessional contributions to super funds to make up a deposit. That's been increased from 30,000 to 50,000. Secondly, the government has introduced or extended the scheme they announced last year to allow an additional 10,000 borrowers was to take out mortgages with a 5% deposit, with the government guaranteeing the other 15% before you need lender's mortgage insurance. Now, again, that only applies to 10,000 people, so it's not an enormous amount. And then finally, the government announced a new scheme to allow single parents, 10,000 of them, to purchase a home with a 2% deposit down. So the intention clearly is to allow more people to take out mortgages than would be the case if they had to stump up the 20% deposit from their own resources. And that will add to the demand for housing, but only in a limited way, given the caps on the number of people eligible for those schemes. Frankly, these disturb me. First of all, because, I don't think we need to add even further to the demand for property at the moment. I think one of the failings of Australian housing policy over the last 50 years really is that we have increasingly adopted policies that have the effect of inflating the demand for housing, whilst walking away from policies that were pursued in the immediate post-war period that focused for the most part on increasing the supply of housing, whether it was governments doing that directly through their own housing programs or by facilitating the construction of new homes by the private sector. We've walked away from that over the last 50 years. And particularly at the state and local level, governments have adopted policies that make it either more difficult or more expensive or both to increase the supply of housing, particularly at higher densities. And in those circumstances, it's no wonder that house prices have risen from what for almost 40 years after the end of World War II were pretty steady average of 3 times average weekly earnings to now in Sydney and close to it in Melbourne being more than 7 times average weekly earnings. That's been great for people who already own at least one property, but the consequence of it has been that our home ownership rate, which used to be one of the highest in the world, has been falling steadily since the mid-1960s, and at the 2016 census was lower than it had been at any census since that of 1954. Indeed, at the 2016 census, the home ownership rates for people aged under 45 were lower than they had been at any census since the census of 1947, and I suspect when the 2021 census results are released around this time next year, we'll see that there's been an even greater decline in home ownership rates over the past 5 years, which I think is both regrettable and testimony to the failure of the kind of policies that governments of both political persuasions have been pursuing to boost the home ownership rate.
I suppose to counter that, though, we know what an obstacle the deposit is for the everyday Australian. So how do we help them with home ownership, if not to make that deposit more accessible to them?
Well, I think the answer ultimately, and by that I mean the sustainable answer, is to back away from policies that inflate the demand for housing and put upward pressure on prices. But the reality is that in any given year, there will typically be around 100,000 people who succeed in becoming home buyers for the first time. And up to the point at which they do, they want governments to do things that will restrain the rate of growth in house prices. But as soon as they succeed in becoming homeowners, those roughly 100,000 people a year join the 11 million or more other Australians who already own at least one property, or the more than 2 million who own 2 or more properties. And the last thing that those 11 million Australians want governments to do is anything that would put a brake on property price inflation. And so, to put it bluntly, you've got 100,000 people or so who would like the government to take their foot off the property price escalator or accelerator, and you've got 11 million Australians who want the government to keep the foot flat to the floor when it comes to property prices. Even the dumbest of our politicians can do that electoral arithmetic, and they do. So I think, excuse the cynicism, the sad reality is that there are far more votes to be had in keeping property prices going up than there are in pursuing policies that would restrain the rate of growth in property prices so that more people could afford to buy them. And that's why the home ownership rate has headed steadily but slowly downwards over the last 50 years.
So we're also now watching what's going to happen very closely, as always, with interest rates. In the event that we do see a rise in interest rates in this year at some stage, if that does indeed happen, what can buyers and sellers expect the effect of that to be?
Well, I think when interest rates do go up, the consequences for the property market will become quite quickly noticeable. One of the reasons for the very strong demand for property over most of the past 12 months from first home buyers, although now with the tapering of the very generous federal and state government grant programs for first home buyers, that's now starting to taper off. But investors who withdrew from the market in late 2018, partly, I guess, in anticipation that the Labor Party might win the 2019 election and change the tax treatment of property investment, when that didn't happen, property investors took a while to come back to the market, but the lending data show that since late 2020, investors have been coming back into the property market, particularly in Sydney and to a lesser extent Melbourne, in quite a big way. So I fear that we're once again seeing a situation where would-be first-home buyers are going to be squeezed out of the property market by people who already own at least one property. But we've seen a lot of people borrow a lot of money to buy property on the expectation that interest rates are going to remain at record lows until, as the Reserve Bank keeps saying, 2024 at the earliest. Now, I don't dispute for a moment the Reserve Bank's judgment that inflation isn't going to start rising to the 2 to 3% target band, which they're aiming at, until the unemployment rate is sufficiently low to generate higher wage inflation. But in my view, the risk is that we will get to that point somewhat sooner than 2024 at the earliest. Indeed, I think we could be down to the 4.5% inflation rate that the Reserve Bank is targeting, 4.5% unemployment rate, I should say, that the Reserve Bank is targeting, perhaps as early as the end of next year, in which case the Reserve Bank does have a dilemma. Do they do what they should do when inflation is beginning to rise or getting back into the 2 to 3% target band, which is to start gradually raising interest rates? And if they do that, I don't think they'll have to raise them by very much, because there is so much household debt out there that even small increases in interest rates will have a significant dampening impact on household spending. Or do they say to themselves, we made a sort of promise, or at least what people understood was a promise not to raise rates until 2024 at the earliest in their terms? Well, if they do that, then they may well find that they have to increase interest rates more quickly and by more once they start doing it than would have been necessary if they started doing it when inflation first got to between 2 and 3%. Neither scenario is particularly attractive for people who've taken out large loans, but I think when that happens, and we've already seen, at least in the past week, one of the big four banks lift their fixed rates, which is an indication that they're sniffing the breeze as to when official interest rates might start to move up, then I think we will see that that's quite a significant dampening influence on property prices.
Are there any countries around the world doing it right, do you think, Saul?
Well, Singapore, for example, which has seen quite significant property price escalation over the last 20 years, has always done a lot to increase housing supply, including by having the government-owned Housing Development Board build a lot of apartments. There are some ugly politics around where some of those apartments are built and renovated, but they have focused on boosting supply, and they have sought to restrain demand, particularly from foreign investors, more assertively assertively than most other countries have done. Canada, more recently, although it's seen some quite significant house price inflation, has in recent years made a conscious effort to boost the supply of housing through a variety of government programs. There are some European countries like Germany that have been quite successful in avoiding house price inflation over the last 25 years, although they do now seem to be having a bout of it more recently. But of course, countries like Germany, France, Switzerland, Austria, home ownership has never been as important socially as it has been in countries like Australia, New Zealand and Canada, because they have a very different attitude to long-term rental. And I'm not suggesting that we could or should adopt their practices in this country. They probably wouldn't be a good cultural fit.
Yeah, it's an intriguing situation we found ourselves in, but I really enjoy your insights into explaining it to us today. So it's been really fascinating talking with you. Thank you so much for joining us on Property Unpacked, Saul.
That's a pleasure, Alice. Thank you for giving me the opportunity to share all that with you.